Good morning, everybody, and welcome to the October installment of the Balanced Perspective. I'm your host, David Levinson of Net Group Investments, and always we're joined on the line by Iain Power, the CIO of Truffle Asset Management and Portfolio Manager of our Balance Fund. Iain, as always, thank you very much for joining us today.
Morning, Dave, and morning to everyone joining us on the call.
And what a heck of a month it has been since we last caught up. I mean, politically, just in the last week, we've had the far right in Brazil contesting the election there with the leftist Lula da Silva, and looks like we could see a regime change away from Bolsonaro to da Silva there. In Iran, we've had some social unrest and protests there. Even here in Africa, there's been a changing of the guard in Burkina Faso. And then, of course, the eastern Ukraine and the annexation of those regions by Russia. We've also had the aptly named Hurricane Iain sweeping its way across the Gulf of Mexico, Cuba, into the US. I'm not sure if Iain has a view on the naming convention of hurricanes in light of the latest name there. But probably the hurricane aside, the most notable event to shake at least the foundation of global markets in the last week even has been the move by the Chancellor of the Exchequer in the UK and the Prime Minister there. And this is where I want to bring in Iain. It's a slight deviation from the topic I was hoping to address today is I guess the market was looking for some sense of stability from Kwasi Kwarteng and Liz Truss in the UK, and instead they got something that was maybe quite pro-growth, and the timing was a little bit off. But through the eyes of a bond investor, a global and a local bond investor, how have you made sense of what's happened in the UK from a sort of portfolio management perspective?
Yeah, Dave, I think you're right. It certainly injected a big helping of volatility into markets, and I think perhaps the observation is, when one takes a step back and looks at what Liz Truss is saying, and I guess in terms of what she wants, it's all good and well to say that you want to lift growth and, improve, I guess, the underlying competitiveness of the country. But when you sort of think about, a country as, for example, a company that earns profits or revenues, and in a country's, I guess, example, that would come in the way of tax receipts. And those tax receipts are then used to pay for the running of the country. And it's all good and well to say that you want to cut taxes to then obviously stimulate growth. But it then comes at a cost of having to tap into capital markets to then borrow that funding requirement. So we all know that we can't spend more than we earn. And from a country's earning perspective, those taxes, I think, or the potential lack of those taxes caused a huge negative reaction in terms of bond markets, to the extent that there might be a much bigger borrowing requirement, which would push the UK into almost a double-digit budget deficit. And these sort of policies are akin to what you've seen normally in emerging markets. And interesting, just chatting to some of the UK guys and strategists, and they were all in shock and horror and saying, this is typically what you would expect from an emerging economy. And I think you saw the pound take a big hit in addition to the weakness that it had suffered. And I think, the jury's out. I mean, Liz and Kwasi have tried to walk back some of the stuff. And I see there's reports this morning that perhaps the relief to the top end, the really wealthy guys might be pulled back. But, the bottom line is that causes uncertainty, and capital markets like certainty. And to the extent that there's going to be bigger holes to fill, in other words, where the government's tax receipts will perhaps be lower than expected because of tax cuts, that means you have to fund it. And in this environment where you've got the upward pressure on inflation, it just seems as though these policies are at odds with, I guess, the bigger picture of trying to get inflation under control, and has now had the consequence of jacking up borrowing costs even more for consumers, and more importantly, from a discount rate, from a property market point of view, when you look at mortgage rates, that then obviously puts consumers under more pressure. So I think it sort of really talks to an inexperienced I guess, head of the UK finances, the exchequer, and maybe Liz Truss not fully understanding market, the way it works, and I guess what is available to her in terms of trying to stimulate growth.
Thanks, Iain. We did see them take that U-turn yesterday, I think, back up to that 45p tax rate. I remember it being almost as high as 50, I think, during the global financial crisis. But it brings me a little bit to the topic for today around currency management, because I think in your balance fund you manage for us, one of the top contributors year to date has been the management of currency. I think moving rands into dollars would have been a good move if we rewound 6 months ago or so. The UK have obviously felt the full force of the financial markets with the sell-off in the pound. Quite a harsh lesson for the new leadership there. But maybe the best way to get your view on currencies, if we think about dollars, sterling, euro, yen, and even the rand, is how you're currently positioned around these and where your exposure currently lies. So maybe a little bit of insight into your thinking there from a portfolio currency perspective.
Yeah, look, I think, the global macro has certainly been one which has favored the dollar, and we've sort of said it for quite some time, is that the US is the cleanest dirty shirt. So it's a very closed economy where sort of consumption services make up circa 70% of GDP, which means that things which happen in the rest of the world have a lesser impact on the US than perhaps what they do in the UK or Europe or China, for example. So the US really has been in a better space and, is not struggling with the issues that Europe is from a conflict point of view with the Russian incursion. And that has made investors flee to the dollar and I guess flee to those US companies and assets which have been performing relatively better. And I'm talking at a business level, not at a stock market level, than the rest of the world. So that environment is typically very positive for the dollar and very negative for all the other currencies. And, the rand has been no different, I guess, to many of the other currencies. And we've seen it weaken, along with, the euro, the pound, the yen, the renminbi, etc. And I think that process will probably continue until we get to the point where, the Fed is pretty much done with its hiking cycle, and it will probably come in tandem with some weakening signs of the underlying economic activity in the US, which we expect to start to unfold into 2023, and that probably holds some relief for all these other currencies. But one's also got to ask the question from a longer term structural perspective. If you look at Europe and the UK, and where many of these economies are paying 2, 3, 4x more for their energy than they used to, has there not been a structural change in their competitive advantage? And that will flow through to inflation, and ultimately currencies will tend towards inflation differentials over time, and it probably means that European inflation is going to be higher on a structural basis, which I think talks to perhaps what purchasing power parity would suggest is a fair value for the euro, for the pound versus the dollar, and then of course the rand caught up in all of this as well. So what does it mean from a truffle perspective? Well, we externalized quite a lot of capital during periods when the rand was very strong. I think we took advantage when the rand was sort of 14.40, 14.50. We've had bouts of sort of weakness, and at the moment we're actually going the other way, David. We're actually bringing money back. We think at a rand closer to 18, you really are buying into some of these SA assets at cheap prices, whether it be our equities or our fixed income. So we're doing it gradually. We're not doing it aggressively. We're still sort of in excess of where we were at the beginning of the year in terms of our offshore exposure. But certainly we're bringing a little bit back now where, we think fair value for the rand against the dollar is probably closer to 15.
Thanks, Iain. Yeah, I think I saw a headline yesterday about European inflation currently coming in around 10, 11% there. So quite a different story to what you might be seeing in the US. But with regards to that sort of foreign currency bucket in your portfolio, I think you added around 10% in offshore cash about a month or two ago, and now you're saying you bring a little bit of that back. So when you guys look at cash, is it about actually hard currency positions or a derivative overlay on some of that?
So at the moment, it's been hard cash positions. So we were up at about 43% offshore, and we've sort of brought, around about 7% of that back after this latest bout of rand weakness. And really what happens is when you get these blowouts in the rand, you normally get dislocations in our bond market. And we've been relatively short duration this year for quite some time. And then into that rand weakness, we've sort of brought back some rand and then taken advantage of the blowout in our yields. Specifically the 2035, the 2032. You can get almost close to 12% in terms of returns. And we think, into periods of stress like this is a great time to be buying when everyone else is panicking. I think the SA finances, notwithstanding the issues that we're facing, from a debt to GDP perspective, are still relatively okay.
Yeah, I think what you talk about also is a global dynamic around the carry trade, being able to borrow from a region at a certain low percentage and invest it somewhere else where your yield is obviously significantly higher. I think what's been interesting is the SARB is probably moving a little bit in step with the Fed, so there's no interest rate sort of necessarily informing that move between dollars and rands. I think the Fed are looking to maybe up rates by about 150 basis points going into end of Q1 next year. Probably similar movements here in South Africa. But obviously, a weak currency can mean a couple of things. The first is, I guess, for the rand, as the world might be in a risk-off environment and there are recessionary concerns. Then depending on the environment, sometimes a weak rand is not a bad thing for investors who have invested offshore, for local companies that probably generate a lot of their earnings in non-rands or dollars, and then of course for our export competitiveness as well. So from a fund management perspective, is this rand weakness a cause for concern and to take risk off the table, or is it a matter of actually sitting back and saying we think this could be an opportunity to buy into rand weakness?
No, I think it would be the latter. I think, the South African rand is a barometer, I guess, of risk appetite globally. And when you see these periods of extreme rand weakness driven by global factors, that normally suggests that global investors are becoming a little bit more cautious around risk. And I think, from a SA perspective, given the potential reforms in the power space, the very attractive valuations that many of our businesses from an equity point of view are trading on, and the very generous real yields from a fixed income perspective, we think that this is a good hunting ground for some great opportunities to deliver double-digit returns going forward. But I mean, it doesn't mean to say that we can't get shocks globally, and I think at the moment that's really what's driving our currency. These are not internal factors; these are external factors, and the environment and potential for those shocks is still high, and one has to acknowledge that. So, I mean, as we speak, the Ukraine is pushing forward and is pushing the Russians back, and there's worries that Putin might be cornered and then do something silly, and of course, all these things could have a big bearing and impact, in terms of global risk appetite, currencies, interest rates, etc. And we just hostage to this bigger pantomime that's playing out. But the one thing that we can always do as managers of money is focus on valuations and what's priced into assets. And already in a lot of these SA assets, you've got quite a lot of bad news, which is already priced into them. And certainly if I had to put up a chart for you right now, bar charts of sort of countries around the world and their inflation rates, South Africa on that chart with our inflation at the moment is closer to Switzerland versus, which is low, like China, it's sort of towards the bottom, whereas Europe, Germany, UK, US, they're all right at the top. So we don't have the big second round pass through worries around inflation that you're seeing in perhaps Europe, UK, and to a lesser extent the US. And I think that sort of bodes well for us to the extent that our companies can get the benefit of the weaker rand and the commodity prices and that competitive edge, while still not seeing costs blow out to the extent that you've got the second round inflation coming through. So I think in the short term it's a positive, and bearing some shock between Russia and they do something silly and there's a confrontation between NATO. I think 2023, to me is starting to look like it could be interesting for returns for our SA clients.
Okay, thanks, and we look forward to hearing what you have to say in 2023. Can't believe we're talking about that already. We're in Q4. As always, spot on 15 minutes. Thanks for your time this morning, and we'll catch up with you in a month's time.
Great. Thanks, David, and thanks to everyone who joined us this morning.
And just again to recap some of Iain's highlights comments for today, or at least the ones that I took away. Tax cuts come at a cost, and the UK government, given what they were proposing last week, means they then have to tap into capital markets to meet their debt requirements. And we've seen the sterling almost react as though it were an emerging markets, as Iain put it. Iain also said a quote that I've never heard before, is that the US is the cleanest dirty shirt. So with all the struggles that we currently see in Europe, there's a lot of attractiveness to, at least for the dollar, to remain relatively sought after by global investors from a currency perspective. So he remains positive there. Surprisingly, Iain kind of surprised me a little bit with his answer there, that rand weakness is an opportunity to buy into assets. Our equities are attractively valued, which we've been using that rhetoric for some time now. And local fixed income yields are giving decent returns too. We're looking at inflation plus around 4%. External global markets are driving markets. It's more an existential crisis to South Africa. And of course, these risks currently still remain very high with what's happening currently in the Ukraine and Russia. So from myself and Iain, as always, thanks so much for joining us, and we'll catch up with you in a month's time. Take care.